Welcome everybody to our Arizona Real Estate Roundtable. I am today going to be your host. I'm Rick McCone, otherwise known as your digital leader today. So I'm glad you guys could join me. This is going to be fun. So we've got Jacqueline Smith sitting right there next to me this way. Then on the other side, there's Pat. What's my rate, McMasters?
Brady Bunch thing again?
Yeah, we're going to try that. Yeah, way over here is Ruby. Thanks, Pat. You got that. And then we have Caitlin McKeag down on the bottom. Everybody knows who she is. Sean Shackleton and Dan Frio from the great state of Illinois. Welcome, everybody.
It's good to be here.
What's the temperature out there, Dan?
Yesterday, the wind chill was like negative. I think they said like negative 30. Dude, when I walked out of the office, you couldn't breathe on my way to my car. It was nuts.
Oh,
and then I see you guys all there in the short sleeves and the tans and everything, and I'm here freezing my butt off.
Well, and everybody's, why you have a guy on from Chicago talk about Arizona? Well, Dan is a national lender with a very prominent YouTube channel, so I wanted to have you on and see if we can answer some questions from our guest today. Bear with me.
Sure. Thanks for having me too, Rick.
I had a lozenge in I had the worst cold last week. So let's get rocking and rolling here. I want Dan, I'd like to know because as we're talking about, oh wait, we have a new guest here. We have Rahima. Welcome, Rahima.
How are you?
We're good. We're live already. So
awesome. Okay.
Rahima's with Keegley Homes Investors, and I'm anxious to find out what's going on in the market of investing. So Dan, first question out of the chute here.
Yes, sir.
We're all kind of anticipating January coming. Man, it's probably going to get better. Rates are going down. What are you seeing? Are you seeing an increase in mortgage applications? Is it kind of like last year, more the same or better?
You know what? It's all Fed dependent and Fed data dependent, I guess is a good way to say it. What the Federal Reserve's been doing is they've been seeing inflation coming down, but they didn't want to kind of show their card. So many of them, they kept sitting back saying, we're going to still increase rates if the data deems so. They never really came out and said, we're going to cut rates. But then at the last meeting, and the reason why they weren't doing that is they didn't want exuberance in the market. Because I said, as soon as they come out and physically say they're going to cut rates, you're going to see the stock market probably go up huge, and you're going to see mortgage rates plummet. Well, at the last Fed meeting, the Federal Reserve chairman came out and he said, he started just hinting at, I think we're pretty much done. And, the dot plot that we're looking at is saying, we're probably going to start cutting rates in 2024. And then the market went crazy. You had interest rates go from 8 to about 6.25. And Pat can vouch for this. It was like a 48-hour period, which is is unheard of. And then you saw the stock market instantaneously, it was up 500 points. So then that basically brought us down to where I think we should have been right now. But now the data coming in is inflation's really sticky at this point. And the other day we had some decent inflation numbers. There's two numbers, and I won't drive you guys crazy with this. There's a consumer inflation number and a producer inflation number. One is the CPI. I think a C is consumer, and the PPI is producer. So for the P, those have been coming down, but the last readings they were up a little bit. And then retail sales came in today, and they were double what was expected. So now the Federal Reserve's sitting back saying, well, look, think of this as if you're a producer of something. You own a store, and you have this product you're selling, and you keep selling it. You keep raising the price, and people keep buying it. And then you raise the price, and people keep buying it. And you keep raising the price, and it's still exuberance. Well, why would you cut the price? Right. So that's where we're in right now, because the data is kind of wishy-washy. You have consumer prices kind of coming down. The producer prices are coming down nice, But then you have still the consumer that still just keeps spending, and there's that spending is what's keeping up the inflation numbers. So just today alone, we had the retail sales, like I said, and those numbers are coming in, came in really strong. So I did a live event earlier today. I'm kind of just opening my cards to what my forecast, I guess, is for 2024. And I kind of nailed it last year in a lot of avenues. So here's what I expect with rates. So last year I came out with a forecast for 2023. And I said, rates are probably going to be in the range of 5.5%, 6%. And there's a lot of things I do in the background to give you that data. I don't just say, rates are going to be here. There's a lot of historical data in there, the 10-year treasuries and so forth. And then I missed that because rates, they were at 7% or whatever. So I missed it. Well, I wasn't that bad off. And then I said, the markets are going to be completely stagnant. You're going to have some markets a little bit up that didn't have the big exuberance that a lot of areas saw. Like you guys saw a big flux in, and you had like Austin, Texas, and things like that. I said, those markets will have a little bit of a pullback, but truly there is no inventory. And you guys can vouch for that. And that's why I love joining in today, because I want to see your side of the fence on this. But the housing, unless rates get to about 5% again, you have most people kind of like me. I got a rate at 2.625 on my home. Even if I downsize, my house payment would go up. So what's the point of downsizing? So I'm still expecting rates historically should be, based on the 10-year treasury and everything else, historically rates should be right now about 5.5%. We're at 6.5. So there's a 1% buffer there. That's basically a profit margin for a lot of bond traders. And then you're going to still see, unless rates come down where people start putting their existing homes on the market, you're going to see another flat market unless it's that, because the builders, they're not building enough to increase that inventory enough. And then you also have people that have these channels that say, foreclosures are running rampant. Well, anything you can use a percentage on anything to really prove a point. If you're coming off of a foreclosure moratorium, or basically you can't foreclose on anybody, and then you have 10 foreclosures, you can say, wow, the foreclosure rate is skyrocketing.
Well, that's where you hear me say that a high percentage of a small number is still a small number.
Yes. So you don't have foreclosures hitting the market. So there's no for a price of anything, a house, a car, whatever, to go down, you need too much of it and less demand. We don't have that. You don't have too many homes in the market right now. If you get there and you have a flood of houses to the market, yeah, you'll have a reprieve of a little bit on the prices. But right now, you're not seeing that. And then like I said, on the interest rate front, basically just a little historic data. If you go back over time and you ask any old timer like me in the business, you usually take the 10, people never used to look at really mortgage bonds to see where mortgage rates are. They would look at the 10-year treasury and they'd say, okay, historically, if you add 1.5% to the 10-year treasury, which currently is like 4% today, that's where mortgage rates would be. That's how it works, because all these bonds trade on Wall Street. Well, you have people not looking to buy mortgage bonds right now. So what happens is the prices have to continue down for some investor to buy it. And that's what's happening, pushing up the yields to now spread. Instead of having a spread of 1.5% added to the 10-year treasury, you're having a spread of now 2.5%. But again, once that starts to condense with bond traders and everything else, we should have a rate back around 5.5%, 6%. And that's the reasoning behind it. So that's kind of my expectation.
That leads me up to my next question for Pat here. And thank you, Dan. I'm going to come back to you.
Sure.
And for people that are on there asking questions, we will get to your questions in a bit here. But so Pat, I was asking you earlier, because I've had people comment to me on the show, and I'm sure Caitlin and Jackie and Sean have all had the same comments come up when you talk about these 2-1 buy downs or 1-3 buy downs to say, and you can refinance later. Well, the question always comes up, well, what if I don't have any equity? What if real estate prices go down in 2025 and I've lost all my equity? Can I still refinance?
Yeah, I mean, that's kind of a dismal, that would be saying that markets, obviously, Dan, we were back in 07, 08, you saw markets go down, 30, 40, 50%. But the simple answer is yes. I'm going to really make it simple. On a VA and FHA loan, you can refinance well an appraisal. It's as simple as that. So that takes that two set of loan, programs out of the equation for if you're worried about values, because you could do a VA IRL or FHA streamline without an appraisal. So that knocks those two sets of the loan programs right out. Conventional, yeah, you might, certainly there might be some questions there, but let's say you put 20% down and you're at 8%, and let's say the values fall 10%. If rates go from 8 down to say 5.5, I'm just going to throw this out there, that your difference in rate from 8 to 5.5, you might have MI, but if you got great credit, your MI is probably going to be a lot cheaper than, that combination of the going from 8 to 5.5. You're going to probably save $500, and you might have an increase of MI of say $100, and then MI can fall off. You might be in a situation where you're, got a new appraisal and you're 83.5% loan to value. Well, okay, you got about 3.5% to go. And that eventually will fall off. You might have to have MI for a year and a half. So the simple question is, we'd have to be in a crazy, if the markets fell off 40%, but then you look at 08, 09, or 2010, 2011, the government came out with the HARP program. Said we don't care about your values. If it got to that point where it was, oh my God, the world's falling apart, the government's going to say, hey, you can refinance. We don't care about your value. If you got a Fannie Mae loan or a Freddie Mac loan originated from this date to this date, you're eligible for this program. So there's a lot of ways to combat, those falling, the sky is falling type of programs. Make sense?
Yeah, it sure does. And I was going to ask one last interest rate question while I've got you here is that, I watched the speech. I saw what, Chairman Powell said, and he didn't say there were going to be 6 rate cuts next year, did he?
No.
Where's that coming from? I'm seeing it all over social media, 4 to 6 rate cuts coming this year. Where?
People
you want to go answer that, Pat?
No, go ahead. I'm just saying the people that just watch the media that don't really know the markets.
Yeah. So
where's all the crash guys coming from?
Yeah.
None of their stuff makes sense either.
Yeah. So
but if they say it long enough, it will eventually happen.
Sure.
That's right, Sean.
So what I think where this came from was the dot plot. Okay. So you guys might hear, comments about the dot plot. Some of you might not, some of you might. So what happens is 4 times a year, the Fed meets every 6 weeks. So 4 times a year, though, they come in and there's a chart on the board of interest rates. And now the Federal Reserve controls the federal funds rate. So I won't get into all that. So each member of the Fed sits there and they put a dot on where they expect the federal funds interest rate to be. So some of them actually put it down that the rates are going to drop, 1.5%, maybe 1.75%. Well, we know the Federal Reserve is not going to come in and reduce rates by 175 basis points or 1.75%. So the estimates are, well, they're going to probably do between 1/4 and 0.5% reductions. Okay, so how do you get to, if even some of the Federal Reserve members are saying rates are going to be 1.5% lower by the end of this year, what has to take effect? So if you figure that out, if you say, okay, every time they're going to meet, they're going to take a quarter percent or 25%, 25 basis points hit, that would take it, you'd need 6 rate cuts to bring it down to that lowest level. Now, if you really follow Wall Street and all the analysts, they're expecting 4 rate cuts. And I think I am too. Each rate cut about 25 basis points. So I'm expecting us to be about 100 basis points or 1% lower this time next year from where we are today. When those are going to occur, I don't really know, but I think that's where all the kind of Wall Street kind of read the tea leaves and said, okay, this is how it would kind of lay out if that was the plan. That's where I think everybody got it, because they never even came out and said they're going to cut rates 2 times. They just said they're going to start to lower rates. So
let's go around the room here for a second. Tell me what you think on inventory with this question here, folks. And Jackie, I'll start with you. Next couple of months, will inventory Arizona go up or down?
A lot of people are worried about the lock-in effect still being there, and I think to some degree it will be. But we're starting to see movement. We've got quite a few listings coming up as it is right now, and a couple of them are move-up buyers, which surprised me. But I think people are getting more comfortable with the rates, and we always have necessity, and we always grow for the spring market. Of course, you've got the crash people out there now saying, oh, inventory is growing faster than it ever has, which is not true. But I expect to see the inventory build, but I think demand is going to trickle along right with it. And I'm really kind of expecting a normal spring market. I don't see anything dramatic happening up and down unless some outside factor happens, with war or something. With the biggest concern I have is the deficit and then the commercial banking. And so those are the two things I think could throw wrenches in it.
Sean, what do you think?
I don't disagree with what Jackie said. I think that we're going to see our inventory go up, but that's normal. This is the time of year that we see our inventory go up. But what I see in the Scottsdale market is that our demand is also going up. So as homes come on the market, if they're a good house, they're going right back off the market. I mean, the last 3 offers that I've written from mid-December to now, I've been in a multiple offer situation 2 times out of 3.
Wow.
And are you seeing a lot of cash? I'm sorry, Rick. Are you seeing a lot of cash in Scottsdale in the upper end? Because that's what I'm hearing.
Yep. Most of my buyers right now are cash.
Caitlin, you experiencing the same thing?
Well, yes. I mean, I agree in the sense that, our inventory will probably go up, but also the demand is going to go up because that's typically what happens this time of year anyway. And that's what I've been seeing. I've had a number of clients reaching out about listing their homes. So that kind of surprised me. They're all relocation reasons, though, not move up buyers in my situation. But I do think we're going to see more inventory, but I also think more buyers are just going to snatch it up pretty quickly. I had a listing go live last week and we had a lot of activity and got under contract first weekend on the market. So I think we're kind of moving back into that.
So Ruby, are you seeing the same thing?
Yeah, I agree with everybody else. Being the last person, everything that they said is what's really happening. So, yeah, our inventory, I feel like, is going to continue to increase. This is the time of the year that buyers are starting to prepare for taxes being done and their returns and preparing for that spring break move. So I feel like I have a lot of buyers I'm working with right now. And then Jackie and I have some new listings coming up. So that's where we are.
Well, I track the 7-day moving average every day. And so what I've seen so far is, yes, seasonally, we did have our adjustment. We did go up. We went up with listings like we always do in January, and we went up in sales, but the sales have not exceeded where we were before the holidays, maybe by 100 homes. So I'm not seeing them jumping out of the gates. It's kind of like it's almost right at last year's level. I'm seeing that there are still some pockets where things are going great, and we still have like Mechanic Dude here says, but those are people with lots of money, not middle class folks. It's happening in all incomes right now. I just sold a $200,000 condo, and it's an interesting time in the market. It's slow, but it's not dead. Remember that movie Princess Bride? It's mostly dead, not completely dead. and so now I want to jump over to Rahima here, who's with Key Glee, and you are an investor, and you get. I'm trying to find your screen here on my screen. For some reason, I'm not. You disappeared on me. It was probably my fault. Now tell us what you do. You buy homes and remodel them and put them on the market, right?
Well, Keegley is actually a national wholesaler. So we've got corporate stores in Arizona, Florida, Texas, and Maryland, I believe. The rest of them, the other 96 Keegleys are all franchises. So we're probably the largest national wholesaler in the United States. That being said, last year, 2023, we hit some big milestones. We had some of our lowest weeks, lowest months, highest weeks, and highest months. So like from the month of October, we had a record, like we've been around for 6 years. We had a record month in the month of October 2023. followed by a Russian hacking in Fidelity. So we
Yeah.
went from that and then another rate hike. So, you know, it's like, this is what Keely's been doing. Boom. Boom, right? We get hit, we get smacked in the face, and then we die again, and then we have to bring ourselves back up. But all that of 2023 seems to be behind us. The investors are anticipating a rate drop and a bigger spring market, like all of you lovely people have said. So our January sales so far have been well above average. And we're selling 30, we're on track to sell 45 houses this month, just in the Arizona market, not
What's
including
your price point?
everything from you know, the lower end that would, so it would ARV around 400
Mm-hmm.
to ARV 1.7. So all the investors are out and they're all looking. Now, I also sell retail, right? So I do, for some clients, for Keegley, we'll say, okay, look, you're out of state or you're inexperienced, or I've been working with you for a long time, so I'll take care of your flip, I'll manage it, and I'll get it back on the market and sell it for you, and then you know, we'll worry about the profits. If you're not priced right, you're not going to sell.
Mm-hmm.
If you're priced right in the retail market, you're going to sell. You're going to sell first weekend. Like, you're making these offers and you know, things are selling in the first, you have listings and they're selling in the first weekend. It's because you're priced right. Your seller understands that whatever happened 2 years ago, that's not where we are now. That the ARV has to be based on a comp that within the last 2, 3, 4 months. Because even if you do get a contract that's higher, the appraisers and the banks are going to knock you back down to what is supposed to be the price. You know, even if you were lucky enough to get somebody to offer you a price that's over what it's worth. But if you're priced right, like I had a seller who was 20 grand overpriced, and it was, you know, it should have been $399. He wanted to list at $420. He sat on the market for 60 days. I lowered it to $399. I have 9 showings. I'm expecting to have an under contract this weekend. So 20 grand, you know, and his attitude is, what's 20 grand? What's 20 grand? Well, 20 grand in this market is a lot of money in terms of what the mortgage payment's going to be. And that's what you have to look at.
Well, and this
We
is
just
what I
had-
tell when they do this is like the carrying cost for
Yeah.
that, right? Like if you don't price it right, and the sellers say, "Well, let's just try it." We can try it, but now you've got the carry, you've got all of
Yeah.
those other things when you could have sold it. And by the way, if you price it right in the beginning, you're likely going to sell it for more money right out of the gate.
Yep.
Absolutely.
100%.
We just
Well,
had the
there's-
same thing on another listing. Sorry, Rick. We just had the same thing on another listing that we have in Peoria. It was built in 2022, and it's a corporate relocation, and they priced about 20,000 above market. We were getting no showings whatsoever. I told them, because we always lay the ground rules out right from the get-go when Ruby and I list a house. It's like, okay, we'll try your price, but here's the time frame. And when we get to this time frame, because the last thing you want to do, especially in this market, is age a listing, because you're going to end up leaving a ton of money on the table if you do that. So we had an agreement that once we got past January 10th, we were going to reduce the price and be competitive with the market. We reduced the price last month, I think Monday. We had 4 showings, and I've got a contract sitting in my email now.
There you go.
Makes a huge difference.
Now there's the common theme that I'm hearing here, and that is that when you're priced too high, people are literally not looking at it. They're not showing up to even give you a lower offer. They're just staying home.
Yep.
They don't even go look at it until they agree with the price. Is that what you're saying?
Yes.
Going on.
Absolutely.
Our buyers are definitely more sophisticated now than they have been ever before. They have information that they've never had before. They never had buyers that had access to MLS or access to what's the inventory. They relied on us realtors coming along and saying, okay, I have this house, this house, this house. Now they can look up Zillow, Redfin, and a host of others. They have access to everything that we have. So they know exactly what it's supposed to be. They know exactly what the investor bought it for and how much they're making on that, looking at the tax records. So they've become much more sophisticated than they've ever been.
Well, I couldn't agree more. Dan, you disappeared for a second, but you're back. We've got a couple comments down here I know that you're chomping to look at here. One is mortgage rates will be back in the threes come mid-25. Fed can't afford rates where they are. A trillion plus interest in a year is too much. To which Jaron replies, I don't think we'll be there for a long time, if ever. And then 3% won't be back anytime soon. If that comes back, things are really bad. Now, there is a case to be made that the higher rates are going to continue to pile up on our national debt and our interest payments. So is there enough of a correlation there to where you think the central bank is going to have to move just based on that number,
No.
or are they just going to be more concerned about CPI?
No,
And Pat, I'm going to tee you up as well.
yeah. So what happens is you have to understand how mortgage rates are created. Okay. So the Federal Reserve, they control one interest rate, and that's what's called the federal funds rate. And basically all that is at the end of the day, if a bank's insolvent, and here's what I mean. Let's say Citibank needs to have $1 billion in assets, physical reserved assets at the end of the day, and they don't have enough money. So what they do is they go to another bank, get enough money from them to make themselves solvent overnight, and that's how they get it. So that interest rate that the banks pay each other is called the federal funds rate. Now, interest rates and that affects, let me go back for 1 second. That affects short-term loans, like credit cards, car loans, things like that. So that's what factors in that. Mortgage rates are tied to a mortgage bond that trades on Wall Street. Now, here's the tough part about this, and this is what I try to explain to people. Again, when we talked earlier, if you have way too much of something, doesn't matter what it is, it could be houses, for example, you have way too much of it, what's going to happen? Well, the prices are going to drop because you have too much of it. Okay. There has to be a drop in the prices. Okay. So what we're seeing right now is there's too many bonds out there. And Jackie just mentioned the deficit. How does the government fund itself when they have a deficit? We have a $34 trillion deficit. Okay. They issue bonds. So the government issues bonds, corporations issue bonds. That's how they get their money. And mortgage companies issue bonds to get their money. So you're looking at the bond market. So that's what we focus in on. And that's why I said interest rates are tied to the 10-year Treasury and all this other stuff. So you have way too many bonds in the market. So you have too much of this stuff out there, too much debt out there on all levels. So it's going to bring the prices down on these things because an investor wants a higher yield because now they have all these things to pick from. They can pick corporate bonds, treasury bonds, mortgage bonds, all these other things. So what's happening is, there's a flood of bonds into the market driving down the prices and the yields up. So what happened in the past, when rates hit 3%, what happened? Well, we had COVID. We had the worst world catastrophic events ever. So the Federal Reserve, what they did is they jumped into the market and they started buying up mortgage-backed securities, buying up these bonds. And now you have somebody buying too much of something. So when you're buying it, it's driving up the prices. Driving up the prices because you have more in these people buying, and it's dropping the yields. So as long as the federal government just keeps giving away all this money, to everybody, there's going to be way too many bonds in the market, and there's going to be just too much out there. So you're not going to see rates coming down to the 3s or 2s. I hope we never see it again in my lifetime, because the reason we had those is catastrophic events. So again, if you look over history, the normal rate should be right about now, should be about 5.5% to 6%. And it is higher than that. It will come down, but those are the levels that we should probably be seeing over the next year or two. But
now talking about debt, got an interesting stat here, number for you. Dan, I'll hit you. Pat, you don't get to answer this because I've already asked you this. How old would you be if you're 1 trillion seconds old?
Oh, I have no idea.
You didn't say there was going to be a test.
32,000 years.
It's amazing. Today on one of my videos, I put down the deficit, and it's amazing how many zeros a trillion is. You have to hit comma 000, comma 000, comma 0. It's a lot of zeros.
Yeah,
so,
yeah. I don't know. I don't know how we're going to dig out about it. Pat, and I'll ask this to the group as well too here. Every election year, people say, I'm going to wait until after the election. They're going to lower rates because of the election. They're going to improve this because they want to stay in office. do you think we're going to have any kind of effect this year because it's an election year in real estate? And I'll start by saying, I don't think so.
Yeah, well, first of all, I want to say with what Dan was saying about the interest rates, I'm going to just do a Leonardo DiCaprio and catch you. I concur. I concur. That's going to keep it simple. But I personally, like you said, I look at the numbers. I look at data. I mean, econ guy, finance guy, and I look at the numbers. I think Dan would agree. You have to look at numbers, look at data, but you have to also look at trends and psychology too. I mean, trends and psychology definitely play into it. But watching the town hall, watching all this political stuff, there might be a little, I think people are going to use it as an excuse not to buy a home. And I think you're going to have serious people out there who are just going to be buying a home regardless of the political landscape.
Yeah, my experience has been in election years is that, somebody that's walking up to you and saying in October that they're going to wait until after the election, they weren't going to buy in October anyway.
Yeah.
Right.
But now they have their good excuse to tell you why they're waiting till after November. Well, then it's December. I'm not buying in a holiday. And so I think I think you hear more of it, but I haven't really ever seen the numbers that support that.
Yep. Hey,
That's
can I
Tina
just start off with
Tambor-
something with Dan? You're talking about interest rates real quick. I mean, Dan, I totally agree with Dan as far as like 5.5 was kind of a nice little sweet spot. But I also go a little step further and say that it's not so much that rates will fall down, but as long as they're stable. I mean, the problem is last year we had rates go from 3 to 8, and nobody, if you're buying a home or selling a home in the next 30 days, you don't know what the hell's going on.
Yep.
And I think as long as rates stay maybe 6.5, okay, we're at 6.5, 6 3/4. Dan knows there's ways you can get lower, but as long as you got stability, I think that's almost more important than rates going down. I mean, if they go down, I'm telling you, it's to me, it's just, I'm looking at the numbers. It's pure supply demand. The builders are still never going to be building enough because we're behind the curve, 10 years. And there just not going to be enough supply out there there's that shadow demand. We all know there's shadow demand out there for the last 2 years. You got the millennials are building the 25 to 30, 35-year-olds. There's a lot of them out there. They're out there. And you're just not going to have enough. And if rates do drop, you are going to have another little circus. So I think as long as rates stay, high 5s, low 6s, mid 6s, you're going to have, it's going to perk a lot more activity.
And Caitlin, you had a comment on elections, I think.
Yeah, I was just going to say Tina Tambor always says that elections don't affect real estate, doesn't affect the real estate market. And if anything, it affects luxury a little bit because it could affect the stock market. People might pause, but it's not going to, usually it doesn't affect real estate. So that's all I was going to add.
Yeah, I agree with that because I haven't seen it. I mean, I've only been in real estate since 2012, but I didn't see anything happen in 16 and 2020. In 16, it seemed like it was even worse, where people were saying, "Oh, I'm waiting." Well, they're saying that, but they really aren't. They were, like I say, they weren't going to buy anyway.
It's the psychology piece that you were talking about earlier. That's what it is.
Mm-hmm.
It's that everybody wants to, because I remember in 16 too. I mean, I've been doing this since 98. So I've been through a few election cycles. And
I'm right there with you, Sean.
Yeah. And I just remember, and it's when so-and-so gets elected, it's going to be better, whatever side you're, it's always, and it usually, like Caitlin was just saying, the election happens and things usually just kind of trudge along the same way that they were before. And everyone just kind of gets back into the swing of things.
Mm-hmm.
Yeah. The trend is the trend and it just stays that way. I had, you watch if real estate's going up in the election, it's still going up. If it was already going down, it's still going to go down. It's never, oh my gosh, we elected a Republican. Here we go. It just, same with the stock market. I mean, it moves where it wants to move, and then they look for the excuse to say why it moved. So if housing goes down, it'll be because of the election. When the reality is the election had nothing to do with it. So now I know.
I bet you the Crash Bros are going to make videos about it, though.
And I was just going to make that point here and saying that, I know we beat up the Crash Bros quite a bit at least on my channel, but, and I do, because show me some meat. You know, I mean, there was one the other day out, and he was doing one new construction out in Peoria and talking about all these
Surprise.
new homes, and
Yeah.
he was comparing the average income to Arizona, and they can't afford these new homes. Like, yeah, but you got that Taiwanese chip plant not too far from here, and the starting average wage is 88 grand. I mean, you know, throw the right numbers out there. And then I want to shout from the rooftop and say, what's the absorption rate? How many homes are they selling? How much supply do they have? You know, do you mind sharing some of that?
That would give
I
away
sent him
what the reality is.
Oh, yeah. I sent him a message again when I saw that video, and I said, I keep offering to meet with you. Just have all the facts. He doesn't know all the building along, all the industrial that's coming along the 303. Ruby and I see it every day being on the west side over here. It's crazy how much it's expanding. And we're selling those new homes that he's talking about. Remember that one? He was standing in front of one of the houses I had in escrow. I was like, dude, it's an escrow. You're standing in front of it.
You're messing up their YouTube revenue. It's not even the facts; it's entertainment that they're making a lot of money with.
Right.
I recently saw a guy on Twitter, X. Sorry, it's X now. That was saying something
X,
about
formerly known as Twitter.
the foreclosure rate in Phoenix was so high, gave some crazy percentage. I literally pulled it up and I said, I just searched all of Maricopa County. There are 12. 12.
Did he respond to you?
Somebody else did and said, well, you just messed up all their data.
Their followers don't listen to you. It's like they just bash you like you're in it. And I'm like, I'm just giving you the facts. They cherry pick a subdivision that they want to get their, their point across. And I'm like, well, okay, but you're making it sound nationally. That's what trust me, folks, don't try. I know a lot of these guys, they're not going to respond to you because they are making more money on YouTube than they ever made in real estate. And they're not going to change. And by us trying to interrupt them, it's just putting fuel on that fire. But I can almost guarantee, go to each one. And this will be my last take on this. Go to each one of their YouTube channels. Go back about a year and a half. They used to get about 300 views when they were just realtors and people like us. Then they went on to the crash, doom and gloom stuff. And then now they're getting 20, 30, 40, 50,000 hits a day, making 20 grand a month. And I wish they would disclose their revenue they're making from YouTube, because I mean, most of the people might then see through, the smoke, if you know what I mean. So, and I know a lot of these people too. So
I've got a great idea, actually. Why don't we got 8 of us. Why don't we get 8 Crash Bros and have a whole YouTube channel, us versus them?
They'll never
do it.
That would be an interesting YouTube channel.
I agree. They would never in a million years do it.
They'll never.
There's one out there that never answers a question on the comments, and he's in California. And I'm not going to sugarcoat this. No rainbows, no unicorns. Oh. And if you ask a question, he doesn't answer. And for
to anybody.
1 week there, I think he put in a bot, and it all said, "Thanks for the comment. Good to hear from you." And all auto replies. But I just asked a question. Well, what is your months of supply there? But I want to move on to Monty's question here. Would love to hear some stories about sales volume. How does this year compare to last year and the year before, January 24 compared to January 22? Who wants to tackle that one? Nobody.
Well,
huh?
I can talk about it. I was just pulling that up on the Cromford report to see where we're at, but they don't have January 2024 data in yet because we're 17 days in. So I don't have that. But January of 2023, we had 4,351 sales. And then January of 2022, 7,000-ish. And 2021, we were around 7,300. So, it's down a lot last January. I would imagine, let's see, we ended December at 4,912. So January's probably around the same. I would say probably a little higher.
This January.
Well, we're only halfway through the month.
Yeah.
So we still have a couple weeks of.
I'm seeing this January has in sales gone up, but not much.
Yeah, that's what I've seen. It's just a tiny bit higher than last January.
100, 150 on a 7-day average. Now, next question here is we have Daniel here asking a great question. Opinions on the record-breaking Phoenix apartment volume coming online. I'm seeing more and more price incentives, 4 to 8 weeks free. That's the first thing you see when you're starting to have higher vacancy rates. Move in here. First month is free. Second month's free. No deposit. I'm seeing a lot of apartment complexes out there. Do you think, what kind of effect do you think that's going to have on our real estate market?
I'll go.
Yeah.
So I don't think it's going to have an effect on rental homes. So people either want apartments or they want homes. And I think the thing that's going to compete the most are those build to rents. And it's crazy what we're seeing here on the West Valley. You drive across, along the 101, and it's like apartment building, apartment building, apartment building, apartment building. And I think the apartments are going to suffer. I don't think it's going to affect, there's been some effect with the buy and hold people. I've had a couple people sell those, but I don't think the apartments are going to affect the actual homes as much. I think it's going to affect the apartments. So I think apartments are going to get really cheap.
Do you think, here's my question, because I remember this happened, and Jackie, you'll probably remember this because you've been doing this as long as I have too. When inventory was down and all those things, and there was all these apartments, they did those condo conversions. I have been mad about some of these apartment buildings. Like if those really start to suffer, I'm wondering if some of the owners won't put those into more of a, convert them into condos. And try to
I remember that. Yeah. And
Yeah,
that's
there was a lot of
really,
issues with that when they first started doing those condo conversions.
There were.
That just the codes weren't all there that needed to be there for that conversion. So
Because I don't think that
I feel like the new builds right now, those new build apartments, I feel like they're all forward thinking and they built them so that they can just convert them. So that's, I mean, I don't know when that would happen, but that was the only thing that I've been thinking, like, will some of those apartment buildings be converted into condos and actually have them sold?
Yeah. And that's a good point. And they do seem like they were forward thinking the way they prepped those. I agree.
I think the only thing that the builders might run into conflict with is water. If they built them and they weren't able to prove the 100 years water, they could build to rent, but they couldn't build to sell.
Even apartment, if they're building the apartment, I knew that was true for like the build to rent full communities. If they were doing single family homes, is that true for apartment complexes as well?
I don't think it's different.
Well, it depends. It depends on the area. They have a moratorium that says we're not going to allow you to build beyond where you're already approved for a 100-year supply. Now there is an agency that measures water depth every year to see how close we are. Are we still on track for that 100-year supply? And there's some interesting stuff. I'm going to have a video coming out on it again, talking about water usage. And do you know that our water usage, because I got it right in front of me here, Maricopa County alone, which is home to 4.5 million people and 1.8 million homes, the annual water consumption is 92 billion gallons. Grass accounts for the highest groundwater usage in Maricopa County. So what's coming down the road in January of 2025 is people are going to be mandated to cut their water usage for irrigation by 30 to 40%. Where this is going to fall the hardest is on homeowners associations being forced to go desertscape in all of their developments. And because they'll save millions of dollars if they can do it, but the amount of money that we can save and the amount of water we can save is staggering. But for builders right now to go out and try to build in an area and they can't show that there's a 100-year supply of water, they're not going to allow them to do that. And so it's, and I get that question all the time, and it's legitimate. There are wells that are drying up, and then you've probably also seen that the alfalfa farmers from Saudi Arabia out by the Colorado River, they're not renewing their leases out there. So a question for Pat here. would you say the average mortgage amount being approved for a traditional 30-year fixed rate mortgage come across your desk? No buy downs or other magic tricks.
You talking about the mortgage amount or mortgage rate? I'd say about the mortgage amounts right around 4.25, 450, right around there. Say 5% down. A lot of people are putting, say 5% down. They're trying to minimize the down payment. In terms of rate right now, look at 6 and 3, 6 and 5 ace, right around there. 6 and 3, 6, 7. That answers the question. He said mortgage amount, so I'm not sure if that's what he meant.
Well, Monty has another follow-up comment here and says that these price reduction stories everybody's sharing will eventually impact comps. This is the crash happening in front of you, but it's not so slow you don't think it's happening. What are your thoughts on that? I'll tell you mine right off the bat. The price reductions I'm seeing are not because the value of homes are going down. It's because people had too much pie in the sky optimism of what their home's really worth.
Well, appraisers have to put, I'm not an appraiser expert because they have to go through like 14 million hours of training to get their license, which is incredible. But, they have to check boxes as far as, the demand, the supply, demand, how, there's little boxes in there. Is it falling? But you can still have it falling, but still demand is strong. There's little boxes within the appraisal, report that say, okay, demand is still there.
Well, it's funny with that.
If I'm wrong.
Yeah, no, I just talked to an appraiser friend of mine who does a ton of appraisals. And I was asking him about the last time that we kind of went through this, and the appraisers would go out there and then they would always kind of say, but we're in a declining market. So they would bring the appraisal value down. And I asked him, this was a couple months ago when we were really kind of at the 8% interest rates and things were shifting around. I said, are you being told by lenders that you have to do that? He's like, no, we're not doing any of that right now. Yeah,
we did see that at one point. We have AV8. Dan, got to ask, earlier in the call, you mentioned you hope rates go 1 to 1.5 points lower because that 5 to 6 range is healthy. If that's true, what's the point of your channel, the rate update?
Great question. So I created that name.
So you get out of bed every morning.
Yeah. I created that name and I knew I was getting myself into a pigeonhole on that one because it's just one of those things. So basically my channel, if you watch my channel on a daily basis, it's more of an economics channel. It's kind of for economic geeks. Honestly, I think it's most valuable to you guys, the realtors, and things like that. So when you're talking to your borrowers, you can give them an idea on here's interest rates. I also talk about mortgage programs. I also talk about a lot of other things. We have mortgage calculators. We go through a bunch of other things. So, but a lot of people just don't, if you just ask somebody off the street, what's the rate? How many times do you guys, you're all realtors here. You're talking to somebody looking to buy a house. How often do you tell them, well, today's rate's 8%? They're probably like, 8%? So I want people to be, my whole goal on my channel is just education. We go over rates, but then we go over a lot of other things. I always like answering the question, why? Why did rates go down? Why did the housing market crash years ago? Why did this? So I can keep you informed. The rate update is just the name that I called it, but I think there's a lot more there than just.
Well, I see things too, Dan. I get comments that go, well, I went to Zillow and their rate is, and I'm like, Zillow doesn't have a rate. They list a bunch of banks just like you guys do. You guys are mortgage brokers. You have 30 to 90 to 100 lenders that you're looking at. Zillow doesn't have a rate, folks. They show you this bank, that bank, and look at the small print. Some of the rates that you're quoting me are 15-year mortgages, not 30-year mortgages. So, now I want to let people know too that, with our channels where we share numbers and data, our intention is to keep you well informed. So not only what's going on in the market, but you can be a hit at all the cocktail parties. Somebody on the other side of the room says, hey, what's going on in real estate? You move in. This is your moment.
Well, just to Dan's point, I think, he's up on top of it. I know he's an econ geek. Like, I try to step on a lot of stuff too, because I'm sure he would agree that you got the average Joe client that calls in. They call into a lender that maybe their letter starts with a Q or R. And they just say, I got a 30-day contract. And you've probably heard me say this, but I got a 30-day contract. Okay, we'll lock you for 30 days. Well, maybe that's not, the rates have been going up the last 3 weeks. Maybe that's not the best day to lock is on that day that you get the contract. Maybe wait. People, instead of, and I said this a couple of weeks ago, instead of shopping for the best rate, shop for the guy who's going to shop for the best rate for you because, they know what's going on. I've saved, I'm sure, Dan, you've probably done this too. You save people $3,000, $4,000, $5,000 just on a rate lock by just waiting a little bit or doing it right away. Or it's more important of who's locking the rate versus just quoting the rate.
Well, even, in today's market, you look at, FHA loans used to be for people that weren't so credit stealthy and all that other stuff. Now I have that are 720 credit scores. I'm like, let's go FHA. The rate's 1% lower. Well, you have this cost and that cost. Okay, but you're going to save, the difference in your payment is $300 a month. So that extra, $1,000 you spent, you're going to recover that in two payments. So a lot of people just don't, first thing you say FHA to people and they're like, I don't want an FHA loan. That's for bad people. But you got to understand, when that fits in and fits the topics and so forth. So
Daniel's saying, in my opinion, the only downward pressure to real estate prices are from a surplus of apartments and developments. Is there data on this? I don't see a lot of data on apartment prices except just what we see that comes through the MLS. And unfortunately, these big corporate apartment complexes, their prices don't show up in the MLS.
But as far as developments, I feel like people, at least in my area, they want more development, but we just don't have the land. So that's one of the things that's keeping our prices higher in the kind of Scottsdale area.
Well, I agree that, look, if rent becomes really an extreme bargain and it's just way more attractive than purchasing, then yes, you'll see. I mean, if I can move into a 3-bedroom apartment for $900 a month, or I got to buy a 3-bedroom house for $550,000, I'm probably going to the apartment.
Yeah.
I won't want to stay long, but I'll save money so I can probably get in a house. So yes, Daniel, I think there is an impact, but I also want to caution people too, because there is a theme that I'm seeing on YouTube, and that is people trying to find that one thing that justifies that the market's going to go down. Well, interest rates might go down, but the house prices are going to go down because of, this. They're going to go down because of that. You might also need to ask yourself, oh, what if they go up? I mean, it's not a great thing if house prices go up. I really don't think so. I think we've kind of had enough of that because of affordability issues. But there's a lot of factors out there that can kind of make that horse leave the barn, and we won't be able to bring it back.
I think we all just want to see a nice, stable market. No more craziness. I mean, it was so out of control there for a couple of years. And, unfortunately, with the crash pros too, there's a lot of people that lost money by thinking our market was going to crash. But, I always tell people, if you're going to be in the home for at least 5 years, then if it's the right home and the right time for you, you'll be okay. No matter what the market does, if you're going to stay for at least 5 years.
Yep.
We got a request. We need to add Javier Vendana. Christy, I will reach out to him, but last workshop I went where he was there, he publicly came out and said that he hates real estate agents, so I didn't invite him.
Oh, please make sure you invite him then.
Rick, I know him. Hey, Rick, Kyle's like great friends with him, so I can.
Oh, I know he is. Yeah, they're on the channel all together. I know him and I talk to him, but I kind of bust chops about that, like, okay, well, you hate us, so all right. So
Hey, this
I
question
have,
for
I have-
maybe-
I have a quick question, guys. So you guys are not anticipating a rise in real estate prices when we see some gradual decline or some stability in?
I am.
I am.
I feel like there's a foot in the hose. And as soon as they get these rates coming down to what they think they should be, it's going to be bananas again.
I do too.
Yep. Absolutely. And it's
I
all
think the
going
only
to depend.
thing, I think the only thing that changes that is potentially unemployment, but I don't know that that's going to happen. But if we get to the history has shown, we have data to prove this. If we get to 5.5% on our interest rates, the dam breaks and buyers are jumping off the fence.
Oh yeah.
I'll give you a little tidbit.
For sure.
when rates went from 8 to where we are today, we're having probably one of our best months in years in January. How many people buy usually in January? We're sitting here like, okay, phone ring. I'll have I think I have about 13 to 15 closings myself. And I usually don't do loans. I finally got on the phones because I didn't have enough salespeople. So the demand is there. And that's what I wish we could get that through to people. It's there, folks. And prices are crazy. Rates are stupid, but people are still wanting to buy. And that's the thing, but that's from my side. I'm nationally.
There is so much pent up demand. We've got many clients that, they just took a break. They spent the first 2 years of COVID submitting offer after offer after offer and getting beat out consistently by the investors and the cash buyers that they didn't get a home. And so they signed year leases. And then when the rates were up so high, a lot of them renewed those leases. But I'm still hearing from a lot of clients that are talking about, mid to late spring, that if rates are okay and they can afford it, that they're ready. It's all going to depend on two things could happen. Rates could come down gradually and we could have a little bit more of a stable market to where things don't go completely insane. But if we see rates come, I think if they make an adjustment in March, which I don't think is going to happen, I don't think the Fed is going to make their first move in March. But if we see a move by the Fed in March, I think that's going to bring rates down a little bit faster than what we're anticipating. And I think the floodgates are going to open.
Well, the problem is,
and I hope it doesn't.
If they do make a move, it's going to happen beforehand. It's already discounted in the market a couple of weeks beforehand. So, I mean, the day that, Dan, how many times the Fed makes a move and the rates go up? It's just like, it's already been discounted about 3, 4, 5 weeks, 6 weeks ahead of time. So the market on a day-to-day basis is going to tell you exactly where the market's going to be. The Fed just does their own thing. But like I said, I read a survey that 70% of people, this is several months ago, 70% of people are waiting for rates to go to 5.5. It doesn't take a rocket scientist to tell you what the heck's going to happen if rates do go to 5.5. I'm sorry.
Then we see a situation where people are making multiple offers, waiving appraisal contingencies, 50 grand over list. Like, what was the point? Right? Like, I always say to these buyers that want to buy, I say, well, you could buy now and you could get this great house at a really good rate and really good price that's much lower than it was 3 years ago. Like, when we're comping out houses now, our comps look like they did prior to the pandemic. That's what their houses are. So I said, you could buy it now. You could refi in 2 years when you think you're going to buy it. And then you stand in line and hope that you'll even get to see the house. And I mean,
not just that.
I hated that.
If they buy it now, they can then ask for repairs.
Yes. Yeah.
Money, Reventure Consulting, June of 2021, had a video that said, "We are at the peak. I am now announcing this is the crash in Phoenix. Here it comes. You're going to be down at least 30% in prices." He didn't say in volume. He said in prices. And I am predicting that right now, June of 2021. I think he was a little far off. And the funny thing is, that video can't be found now.
Oh, yeah, no.
It's gone.
Yep.
So I get it. I get what they're doing. Even a blind squirrel finds a nut every once in a while. But please, that's the only narrative you have every day, every video, every day. I just can't watch them. I just, somebody wants to know who our average buyer is right now. Ex-California residents, older cash buyers, 1031 exchanges. It's all across the board. And it's not from any particular state from what I've been experiencing.
All my buyers right now have loans. So they're not 1031s. They're the average buyer between 500,000 and 700,000 right now. I've got some buyers that are under 500. But what they're looking for is closer to the city versus further out. So those are a little bit more challenging, just meeting all their needs. But my buyers are all with loan.
Well, folks, I know I've tied you up long enough today, and I appreciate everybody coming on. I hope we can do this again. And Dan, we'll reach out to Javier and let him know I beat him up a little bit on the channel here. But Javier, we love you. If you're not
Yeah.
doing
Dan,
anything, you can join us.
we'll do this in July and
us in the
August when
next-
it's 115 degrees in Phoenix and it's a nice 80 degrees in
I'm
Chicago.
in. Count me in. You can count Rick, guys, anybody. If you guys need me on any of your videos, YouTubes, if anybody else on here has a channel, I would love to do it with you guys. I enjoy it, and I greatly appreciate you guys having me on here as well. But the invite's out to anybody on here. If you
Oh, that's
wanna
awesome,
reach out to
Dan.
me,
Thanks.
just yell.
All right, Raul, thanks for the comment. It's great. It's great. Great to be on here with everybody. So I'm going to have to cut some of this short here. Actually doing is perpetuating a delay for thousands seeking home ownership. We could go on all day about that. So anyway, thank you, everybody. Have a great week and a super weekend. And Dan, stay warm.
Thanks.
Mhm,
Take
thanks.
care.
Bye.
Take care, everybody.
Bye,
Thanks,
guys.
everybody.